Hi all, welcome to Navya Markets Limited. KPR mill is the latest fundamental call, and this is from the textile sector. As we all know, Indian economy has rebounded strongly from the economic slowdown of 2008-9, and going forward, it is expected to grow at significant growth rates of more than 10%. With such, positive outlook on Indian economy, the discretionary income in the hands of the consumer is increasing and is also expected to increase significantly going forward. And with such higher income in the hands of the consumer, also coupled with changing patterns in terms of buying and consumption, the demand for apparels is expected to be robust in the future, and this would mean a strong demand for the whole textile sector in the future. And not only that, even the global demand for global economy is gradually recovering from the recession, and due to that, the demand for exports from India is also increasing at a decent pace. So with such positive outlook for the whole textile sector, the best play to pick from the textile sector would be an integrated player. And as we gone through the integrated players in India, we found that KPR Mill is the best integrated textile player in India, who can capitalize on the strong growth opportunity in the textile sector. If you look at the other positives of KPR Mills, it is into a strong capacity expansion of increasing its yarn manufacturing capacity by 57%. This is a compact yarn which is a high margin segment. So through this, it can improve its margins, and it can also improve its top line significantly, as it can capture the strong demand for the textile segment. And talking about KPR Mills, its presence is in almost every part of the textile supply chain in the textile industry. It is into manufacturing of yarn, it is into manufacturing of fabric, that is weaving, it is into color dyeing, and it is into apparel manufacturing. So with such an integrated nature, the company is perfect. It can improve its efficiency significantly and report better margins compared to other players. Not just that, its capacity utilization has improved significantly over the years, over the past few years, and if you see, it has increased from 67% in FY 2008-9 to 80% in FY 2009-10, and now presently, in the past few quarters, it has recorded a capacity utilization rate of 90%. So this is a very strong rate. And one more thing is, important thing is, there are a lot of concerns over the profitability of the mills because of the rise in raw cotton prices. But there is a proportionate rise in the price of the cotton yarn on par with at least along with the rise in cotton prices, which helped the mills to report decent margins. If you see, especially KPR Mills has posted strong operating margins of 21%, 22%, 10%. 21%, 22% in the past few quarters, which shows a strong operating profitability in the past few quarters. And one more important factor is that it derives 75% of its energy needs from its captive power generation capacity, and it is also increasing its captive power generation capacity by 60%. So this, you can see that because of this, it is substantially self-sufficient in terms of its power requirement, which would reduce its dependency on state power distribution. So even from a valuation perspective, the stock is trading at an attractive valuation of 7.5 times its FY 2010-11 EPS and 6.5 times its FY 2011-12 EPS. These are cheap valuations on a relative basis, and considering the strong growth prospects of the company and these attractive valuations, we recommend you to buy this scrip at the present levels for a target of rupees 273, that is 35% in a 10 to 12 month duration. If you see the supply chain of the company, you can observe the presence of the company in the entire textile sector supply chain. It is from spinning to knitting to processing to apparel making. So the capacities are mentioned here. So it is perfectly integrated, if you see, among the players, and it is one of the largest integrated players, as I said, in India. The financials are as shown. Even on a conservative basis, we took the estimates, but till then the value, the profit growth and revenue growth has been robust, and the P ratios are cheap compared to other players. Let us also look at the risks. Any economic slowdown of similar to that of 2008 in the developed economies can have a strong negative effect on the demand for the company's products, and thereby it can hurt the sales of the company. Even a sharp appreciation of the rupee against the dollar can also hurt the profitability of the company. So these are the So as I said earlier, there are a lot of positive factors that have been uh, that will help the company to grow at a significant pace going forward, and also the valuations are very cheap. So we again reiterate our recommendation on this stock. Buy recommendation on this stock, and we advise you to buy the stock at the present levels for a target of 273. For that means the 35% returns. Thank you all.